Hello, and welcome to the second episode of Paws. Last week, I reviewed the great improvements that the district has seen academically. This time, I want to talk about everybody's favorite subject, school finance and the tax levy. The district has been financially stable for the last several years in no small part to the financial support of our community through local property taxes and the county-wide 1% facility sales tax. Every December, the school board approves the levy as developed and presented by the superintendent. This year's levy faces some looming challenges. In recent years, Illinois schools, including ours, have been well financed through state aid and federal grants. In the past year, however, this situation has started to change. Federal grants that the district has relied on for certain areas will no longer exist in their current form and are being either eliminated or combined with other grants and funded at lower levels. The image at the state level is not much different. While the state does continue to find the evidence-based funding model that was started in 2017 and provide the promised increases, the situation is different when we talk about what are called mandated categoricals. These are programs that school districts are required by law to have and support, and there is a funding mechanism from the state that is designed to support the implementation of these programs. However, since I first became a superintendent in 2010 until today, the state has not once fully funded these programs. Instead, they prorate them and pay a fraction of what they believe districts actually need to fund the programs. This year, they started prorating even more due to state budget constraints and low expected revenue. It was recently announced, however, that the state is even falling short of the budgeted revenue projections. So why am I telling you this? It is simply to provide context for the levy. The district cannot cut these programs. They are mandated by law and include items like transportation, special education, and special education tuition to other facilities. So let me discuss the levy. School district budgets are divided into several funds as represented by this list. On most of these funds have a tax rate limit as represented by this column here. The district asks for or levies a certain amount in each fund. These requests then have the rate limit applied and a final rate is determined by the county clerk. If the district has outstanding bonds, the county clerk will add these bond payments to the overall levy and calculate the final rate. So our bond and interest levy would be $903,975, and the final levy rate would be 5.0070. That would mean $5.0070, so 0.7 cents, $5.07 per $100 of the equalized assessed value of the property would be assessed as property taxes. This, however, is not the final picture, as $434,900 of the bond and interest levy is the bond for the cafeteria, which is paid from the county facility sales tax revenue and not from the debt service fund. Therefore, the district abates that amount each year to be removed from the levy. That would then lead to something that looks a little more like this. This screen demonstrates how the district's levy would work for a home that had a market value of $100,000 last year. It is based on certain assumptions, including the estimated increase in EAV, or equalized assessed value, across the county. The home was not reassessed during this year, and there is a homestead exemption. With these assumptions, a home that had a fair market value of $100,000 last year would increase in value by 6.044% this year to $106,044. This would lead to an equalized assessed value of $35,348. This is the value that the tax rate gets applied to. So applying the tax rate to that value, and the tax rate for 2025 would be $4.7114, would then show an increase in the tax payment of $127.19. Nearly half of this increase, however, is due to the increase in the value of the property, which was the 6.044%. But I hear some of you say, why raise taxes when the district has spent so much money on things like the cafeteria, the track, and a planned concession stand? Well, that is a good question with a good answer. Ultimately, the answer boils down to these funds, which have limits placed on them. The district is restricted on where funds for certain items can come from. For example, a teacher's salary comes from the education fund. The district cannot pay that salary from the operations and maintenance or capital projects funds. Based on these limitations, we simply do not have the funds in all of the right places to maintain paying for educating our students with expected loss of revenue from state and federal sources. Additionally, with the addition of the school resource officer to the district was already increasing the tort levy. If you look carefully at the displayed information, the desired extension in the education fund exceeds the tax rate limit. The tax rate, if we were to get the entire amount that's being levied, would be at 3.36. However, the maximum rate is 3.2. So the extension that we would be expected to receive would only be 4.7 million instead of the 4.9 which was levied. It was reduced by about $240,000 to stay in compliance with the tax rate limit. The tort levy is picking up some of this, but not all of it. There was already a levy in the tort fund in prior years of just under $10,000. So there is now an increase of about $190,000. A little under half of this provides the salary and equipment for the school resource officer. The rest represents a shift in certain costs to the tort fund for those expenditures that are allowed to be moved. I am not recommending that the board move everything that they can at this time, as that would result in an even larger tax rate increase. And the district currently has some cash reserves that can help to cover this cost. This is a storm that will need to be weathered. People who provide information to school superintendents are saying that we can expect this to last at least the next 5 years. However, the district has an additional revenue stream coming online in the next couple of years that will help us to get through all of this. If you made it to this point in the video, I greatly appreciate it, as discussing school finance and tax levies is not everyone's favorite pastime. Thank you for joining me for this explanation. If you have further questions regarding this material, please feel free to reach out to me by email or phone. I am not really following or interacting with any comments on these videos, so email and phone are best. So until next time, thank you again for your continued support of our students and the work that we do.